I think.
Thank you.
Awesome. Thank you so much. So, hi everyone. Again, good to see you all, and a super warm welcome to Amy for joining us today. I'm super excited to have Amy with us because she's actually the perfect person to talk about venture from so many different perspectives. I'll of course let Amy introduce herself in a bit, but she actually runs the LEAP program at Mercer, which invests in diverse and emerging managers. So I think she would be the perfect person to talk about everything, including what are some of the right reasons to enter venture, how to think about the important skills to have for emerging managers, to how do you become a good fund manager, and the landscape of everything and all of that fun stuff. So with that, another super warm welcome to Amy. And Amy, I'll pass it to you to introduce yourself.
Yes, thank you all so much for having me. I'm really excited to be here. I have been in private markets, primarily private equity, for my entire career, 15 years now, always on the consulting side. So always sitting on the opposite side of the table from the managers, figuring out who do we want to invest in? Who do we want to get exposure to for our clients? So I love this conversation because it's really, when you're sitting across from consultants and asset allocators, what are we looking for? And, that's really what I've spent my time doing is due diligence, sourcing opportunities. I'm a portfolio manager for 8 clients here at Mercer, mostly in the endowment and foundation segment. And then also, run our LEAP program and lead our diverse manager and emerging market research or manager research. So spending a lot of my time, we were allocating our own capital, discretionary capital, as well as building out client pipelines. So it's a very topical point, and there's, especially within venture, there's a lot of people coming into the space right now. And so especially, I would say venture is probably the #1 space we're seeing new entrants more than buyout or special situations. And a lot from the side of, I've been an operator, I sat on that side of the table, I saw how hard it was to raise capital, and now I want to be giving capital. So, so really excited, to talk more about all that today.
Awesome. Thank you so much, Amy. And it's a real treat because you've obviously seen both sides of the table. And then on the side of advising allocators and working with them on fund manager selection and all of that, there's a ton of insights that you would have, but also directly allocating capital through the LEAP program. So I'll definitely ask you kind of a little bit more details about that in a bit. But if it's okay to backtrack in your career a little bit, let's start with your story and then talk a little bit about the other stuff that we'll dive into. Maybe you could talk a little bit about kind of how you had chosen your particular set of careers and how you navigated through all the different turning points.
Yeah, I didn't really know what I wanted to do, honestly. I went to college in San Francisco, and I knew I wanted to do finance, but I didn't really know what I wanted to do in finance. So I remember thinking I want to get into financial planning, and I did an internship at Morgan Stanley. And then I realized, okay, this is just like, I want to be on the investing piece. I want to be fighting the actual investments. So that was like the best internship. You completely decide that is not at all what I wanted to do. And so I moved to San Diego. I'm in Sacramento, California. I've been in Northern California forever and just wanted to get out. So I decided to move to Southern California. And I ended up, I didn't really know what I wanted to do. Private equity was, kind of like a new asset class that like we kind of touched on in college, but not really. And it was really like this catch-all bucket for like, well, anything that doesn't really fit anywhere else, like we just put in this private equity bucket. And so I got really interested in it, and I joined a consultant down there, TorreyCove, which now has merged with Aksia, and started on the monitoring and reporting side, really looking post-investment, what these investments were doing. Like these are 10-year, 12-year terms. And so my job was really making sure that LPAs were followed. How's the performance going? Are they doing what they said they were going to do when the researcher underwrote them? So really looking at the back end of it. And then, which was great to get that, okay, this is, now I know what they need to be doing. Now I need to underwrite and move to the front end of it. and start sourcing managers. And so after about 4 years, I moved back to Sacramento and started. I was actually employee like 12 at a very small consulting firm here called LP Capital Advisors, which was actually started to move CalPERS when they wanted to move from a gatekeeper private equity model to a direct private equity model. So very large first client for us, and really help them CalPERS start their private equity program. And then from there, I was employee 11 and now I'm employee 5,480. Now I'm part of Mercer. And so we've been through 2 acquisitions. So I've been with the same firm for 13 years now, but we've been through 2 acquisitions, and my role has really evolved. And so I started taking the lead on finding and building client portfolios. And then about 1.5 years ago, 2 years ago, we really identified, myself and our global head of alternatives said, we need to be doing more like real sourcing in the diverse manager space. Our clients want it. The market wants it. Not only do we need to measure the diversity in our clients' portfolios, but we need to be bringing them new ideas for their pipelines. And so that's where I was tapped. They said, do you want to lead this effort? And so that is when I started kind of taking the lead on that. We've met with over, 300 diverse managers this year. I also, as part of it, I make sure that our real estate team is doing that, our infrastructure team and our private debt team. So we have teams across all alternatives. And then I also serve as the chair of our investment committee for our own fund LEAP, which was talked about before. So that's a lot of my history and story.
Super helpful. And thank you for sharing, Amy. Part of the reason why I ask you about that is also folks here are learning about venture capital oftentimes for the first time. So a lot of them will have unfair advantage when it comes to whether it's sourcing or evaluating, but they might not have had that much exposure to how the world of venture capital works. So I think what's really cool is that I think we can basically reframe all the terminology that we use in the venture world in terms of looking at venture funds, because you talked about sourcing, but you're really talking about sourcing venture funds, not kind of in a venture context sourcing deals. And then you've also talked about allocating, but allocating towards venture funds and investing in managers, whereas you're really allocating capital. So just want to make sure on vocabulary, we're all aligned.
Yeah.
No one's getting confused with all of this. So thank you for explaining through everything. And then for folks who are not as familiar with Mercer and the role that consultants typically play in the world of allocators and fund managers, would you mind giving everyone a little bit more context on that as well?
Yeah, so most institutional investors, a large portion of them that have large programs will have small staffs. They have staffs of 1 to 2 to maybe 3 if you're lucky people. The larger pension plans, they'll have 8 maybe, but these are large portfolios that they are managing. And so what they do is they use a consultant, and the degree of which they use that consultant varies. There are some very mature programs that say, hey, just make sure that we're re-upping with the right managers, which means, we're reinvesting each time a manager has a new fund. There are some that are starting a brand new portfolio. I just met with a prospective client last week, and they said, we've never done private equity, but we're seeing a lot of hedge fund allocations stream into private equity, which within private equity, we really look at venture capital funds, buyout funds, and special situations funds. So more distressed type funds. And so we'll come in and, typically the relationship is we build out a 3-year pipeline so that the investors are getting to know, if you have a fund that's coming to market next year that I think would be interesting, we get you in front of them early so that they can get to know you, because a lot of times they want to be involved. They don't have the time to go in the market and vet everything. But when we bring them a vetted pipeline of, hey, I think these would be something that you're interested in, we get you in front of them, you meet, we perform the due diligence. So we're doing all the cash flows, we're doing all the on-site meetings. We'll come out to your office, we'll meet the managers, we'll meet everybody in the staff. So we're the ones that do that. And our due diligence usually takes about 150 hours to do. We also run an operational due diligence, which is separate. I have no idea what their report is going to say before I get it, at the finish line. And they really specialize in making sure that a manager, their back office is institutional, that who are you using as your fund administrator? Who are you using as your law firm? Those types of things. Do you have a disaster recovery plan? And especially for new managers, that's sometimes no. And so, so that's where we really come in. So then we will deliver our due diligence to the investors, to these organizations, and they'll usually present it to their investment committees, and then they will be the ones to actually execute a commitment on their behalf. So it's very much a partnership between us. It's us bringing in ideas. They shut down half of them. They love half of them. We introduce them, then they hate half of those. And, we kind of get there, but we're really there to bring them new ideas and also understand their constraints. Like some are very focused on diverse managers right now. Some are very focused on impact and ESG type strategies. Some just want, I want straight down the fairway buyout. Venture is always an interesting one. Like venture returns have been incredible lately. I mean, if you don't have venture, like your portfolio is just not going to keep up. We'll see what happens if they can keep up, but the benchmark quartile rankings, I mean, it's to be first quartile, you pretty much have to have like a 45% IRR these days. So we are seeing a lot of increase where investors used to be a little more scared. They'd be like, we'll do like a fund to funds or something, but we're not going direct. And now there's been so much increased interest in investing in venture, partially just driven by the spectacular returns we've been seeing in the industry. And I think also there's more options. Venture is really a space where we've been a little, hesitant, because if you're not in the top tier, like there's such a differential between the top tier venture and the bottom tier venture. And so there weren't always a lot of opportunities, and those opportunities were really hard to access, especially for our public pensions and our larger investors. But now there's so many more people coming to the market, spinning out from those, great firms that we've loved forever. And so I think there's definitely a much more increased focus on venture, I would say, over the past year.
Absolutely. Super helpful. In fact, all the kind of endowments foundations I've had conversations with all say that they've been having to adjust with kind of just valuations going crazy, but also venture being such an outperformance category for all of them. So I think it's extremely relevant for folks on the call, because many of them are looking to work full-time in venture. Some of them are looking to start their own family offices, start their own venture funds. So it's extremely relevant conversation for them to think about, because at the end of the day, if you are managing a fund, in addition to raising from, the usual suspects of individual LPs, you would work with all the large institutions that, Amy, you work with day to day. So your perspectives are super helpful. If we can maybe dive into venture a little bit more, curious to hear from your perspective, especially because you've met with over 300 emerging managers in the last year. What are some of the typical reasons that you've seen them enter venture with, and how have they been able to build kind of somewhat of an unfair advantage with that particular reason in mind?
Well, like I said, I think the biggest thing we've seen is a lot of successful entrepreneurs now wanting to get onto the investment side of the table. So making that turn, hey, I've done this, I've raised capital, I've sold the company 1, 2, 3 times, and now I'm ready to actually be on that other side and really connect and try to fill voids where I saw them, like I would have loved support in this, or a more active partnership, or I felt like I wasn't even heard when I sat on the other side of the table, especially in the diverse manager space where, venture capital going to women and minorities is low. And so I would say that's really a driving force. Well, we are seeing, as the other piece was, as these really successful large venture firms are getting large, and we're seeing a lot of spin outs. So we're seeing a lot of 2 people. I ran, I was in charge of a certain sector or platform. Now we're spinning out, and we're going to do, while we were a small piece of the big pie, Now we're going to start our own firm and be specifically focused on what that was, but really be the return driver. We have seen some frustration of just, the larger diversified funds and feeling like I feel like I was really generating the returns of the whole fund, but then carry is shared across everybody. And so I would say those are really the two sides, either operators that are ready to sit on the other side, or I've spent 5 to 10 years at a big firm and I am ready to hang my own shingle.
Super helpful. We definitely have operators, plenty of operators on this call with us. We also have folks who have spent time, not necessarily within a venture capacity, but work at much larger funds like sovereign wealth funds or historically allocators, but focusing on slightly different stages than venture. So curious for folks who come from that kind of background, what your advice would be for them if they want to do work in venture, if you would recommend they stay on the allocator side, or if you would encourage them to explore opportunities, potentially becoming an emerging manager themselves.
I think it's really important to get at least some investor experience. We've seen much greater success, or, we see sometimes somebody that was an operator and they pair up, with somebody with an investment background. So, the story is we have an operational background and an investor background. That makes sense to us. We get that. Where we've seen less success, or it's harder, like the fundraise is harder, is if it's strictly an operating background, and we don't have, because even, underwriting investments is very different than, when you just were looking at your own financial statements as a company. So we really like to see, we are seeing some pivot to become, venture partners, or, operating partners at venture firms, to get some of that investing experience, because it does go a long way. And if you have both, it's really great. But you can really create a great network. And so we like to see either both in the same person, or somebody on that senior investment team having some investment experience. That to us is a lot better story.
That is super helpful to know, especially for I think we have more operators than we do folks who have spent time in investing. So it is helpful to know that building that network and working with others who have complementary skill sets goes a really long way. And extending on this line a little bit more, curious to hear from you, what are some of the other skills or attributes of successful fund managers that you would look for, whether they're investing in terms of thinking about their own portfolio in venture, or investing to eventually become an emerging fund manager themselves?
Yeah, I mean, when we look at the exact same 4 metrics, no matter who you are, if you're a first-time manager, a 15th-time manager, we always look at strategy, we look at the team, we look at the alignment, the terms, and then we look at track record. And those 4 things they have to make sense. And so when you're defining your strategy, do what you've been doing. Like when we see someone say, well, I've been doing this, but I'm going to raise a fund that does this because it's something popular in the market, or it needs to make sense with what you've been doing. The strategy, we need to have seen, oh, they understand this end of the market, or they understand whatever it is that they're doing, and to stick to that. We really want to see, sometimes, and it's okay to refine. I will say, we see refinement, especially from like a fund 1 to a fund 2, where they go, oh, we thought we were going to get into that sector or do more of these investments, and like, it just wasn't. So refinement is okay. But I think, when it comes to strategy, we just want a well-defined strategy, something that that you have experience actually doing. And that seems like a good market opportunity. When we look at the team, we really spend a lot of time, especially for newer managers. That's the number one thing we do. We spend more time at the team than anything, because you have a stated strategy, but we don't really know how you're going to carry it out yet. You usually don't have a portable track record, which is fine. It's really the people. Like we need to have faith in the people doing it. And so I would say we always look for, it's hard for us and our investors to do like a single person GP, a single GP firm. Because wonder if something does happen to that one person, and we've seen it. We've lived it, and it, that person, there's people that things happen to, and then they all of a sudden your portfolios with somebody you don't even know. So we like to see at least two people running the firm, at least when it starts. We like to see some sort of history or some reason that you're coming together. It doesn't have to be, it's optimal when it's we work together here or we previously invested together. Even if it's angel investing, it gives us a sense of you were able to get transactions done. You were able to talk through problems, and I think highlighting those things and being honest, we don't expect just butterflies and rainbows from day one. And I think when you're honest about that, hey, we've had real conversations about this. These are going to be our roles here. But we also like to see the hiring plan, who else you're bringing on. And it's great when there's some continuity there too, of I knew this person from here. Those things really matter. It's different than we hired a recruiter and we found 3 people and we're fingers crossed it's going to work. So we really spend a lot of time with the team, understanding what the future plans are, because usually when we're investing at an early stage, it's 2 to 4 people, which is fine. You're still sourcing, you're fundraising. It's been interesting because we've been having discussions lately on, do you need an office? Which is a totally new thing. I actually had to call up our ops due diligence team. I'm like, what score would you give someone that doesn't have an office? Because a lot of new managers that have launched during COVID don't have an office, and I'm not sure they need one. There's 2 people, and do we want them spending their org expenses on that? So they actually said, look, we have a red, yellow, green scale, a stoplight scale, and they said they'll go yellow. It's not red. You're not, if you don't have an office, but we at least want to see the plans. Here's where we are today. When we raise our first fund, when we hold our final close, that's usually what we hear is the plans are then to expand the team to this, and this is what we're going to do. So that's what we're looking for in team, just really to tell the story and to help us understand why you're all together and why it all makes sense. We also look at alignment terms. It's really important to just have market rate terms, which I always offer. If you ever question what market rate terms are, we have a huge database because we look at everything. And so what should my management fee be? Should I have a tiered carry structure? We see that from a lot of the premier venture funds, but it causes a little hesitancy when we're seeing that from a first-time fund, the tiered carry, really, we expect more from a fund 4 or more that's really proven themselves. But we see some people throwing stuff in. So terms is always something that we spend a lot of time on. Your GP commitment, what are you going to put in? And that's less of a percentage than how meaningful is this to you? We want it to be a meaningful portion because we want to have that alignment. So GP commitment's really big for us, especially in early stage managers, and just making sure everybody's contributing to that. Sometimes we see, I sold this company and I'm putting the whole thing in, and which is great. It's a great percentage, but we would, even if they're smaller checks, we would like to see everybody swiping a check alongside of us. And then the last thing I would say when we look at terms is just think about your carry and how you would distribute carry to the team. We really spend a lot of time and the vesting schedule. So carry and vesting schedule. So we like to see vesting schedules that last the entire life of the fund. So typically it's a little more front loaded, 20% years 1 through 4, but holding some back, because carry is really meant to reward you, but also ensure long tenures that we're investing in you now. And we hope that you're still there 10 years from now. So those would be the other main things we look at. And then performance, it's hard. A lot of times most people can't take their track record, but if you can bring any sort of even an angel track record, I did these investments with my own capital, that in itself is really helpful. And at Mercer, we're lucky enough, we have 225 researchers and alternatives. We have the capacity to do reference calls. We will reference call a bunch of people on your list, off your list, to really understand, when you say, I led these deals, we'll take the time to make sure. And if you did, give you credit for them. Yeah, we called, we vetted, they sat on the board of this company. They did, nobody ever really solely leads something at a firm, but we try to understand like how big of an impact you had there. So that was a very long-winded answer, but that's really the specifics in those 4 areas: strategy, team, alignment, performance. Those are the main 4 things that across any consultant, that's where you're going to spend your time.
Tremendously helpful. And I think that's such a great framework for folks to keep in mind, whether they are acting as individual investors or eventually looking to institutionalize into a fund. And I think what that really helps contextualize for us is that being an investor is not the same thing as being a fund manager, because some people spend a lot of time thinking how to become a really good investor, but they forget about all the remaining pieces that's important for actually managing a fund. And so I would love to talk about both of these pieces separately, if that's okay. Want to definitely start by asking you just about being the investor piece. Who typically not only starts out being a good investor, but have been able to grow and become better investors over time? So not the fund manager piece, just the investor piece. Curious, what are some of the best practices you've seen?
I think the more involved investors, the more, and I would say also it's interesting if we've seen investors where they've like created their own thing, whether it be this or something where they go, oh, I actually created this, and incubate things, and people like, you just get to be known in the industry through these things. And so we found that definitely the more in the market, in networking, going to events, those types of things, but also ensuring that you stay disciplined, because sometimes we hear, especially in venture, God, everything just seemed like a good idea, and we miss something, and not beating yourself up. I think you should keep the list. Like, we love meeting with venture managers, and they go, yeah, this is like the dang, I missed it list. And like, we like seeing those too. Like, this is what happened here, and and these are the successes that I actually made. And so I think just staying disciplined, staying with it, finding some sort of specialty. We find that when people kind of are just all over the place, I just invest in anything that looks good, rather than being more sector specific, or finding something in the market that makes a lot of sense for you, because that's how you really build that network out. But I would also encourage, just start something, or start a podcast, or I don't know, like, those are the things that we really see. Then all of a sudden people are reaching out. If you do, it's just a great sourcing mechanism. So I would say those are really the main things that we've seen, as investors have built their own success.
That's a great summary in terms of building something to add value, and then making sure that you're staying disciplined and have some sort of replicable model of success.
Yes.
Not that we'll invest in anything that looks good, but here is a model that we actually have criteria for and filters for what comes in and what goes out. And okay, super helpful. And then on the fund manager piece, which I think applies to a lot of people as well, in addition to being a good investor, I think many of them have started to think about, or have already started writing some angel checks. So what is the gap between being a good investor to going into a good fund manager?
That is the $1 million question. That's what we spend our days trying to figure out. It's honestly, it's hard. That's what we struggle with. We have conversation, we go, oh, I really like them, but will they be able to transition to this? Especially in venture, it's a little harder, because we've seen on the buyout side, like, new managers will, they'll do single company, especially managed vehicles, and they'll establish a little bit of a track record with third-party capital. It's not in a fund structure yet, but they're starting. You can't do that in venture, because you need a bunch of investments in order to find the winners. It's not like in buyout where you make 10 investments and that's your portfolio. So I think it's a little harder in venture, honestly. And I think that's really where we look at what experience do you have, and And that's where that institutional type venture investing experience, it really does. If we see that you came from some, VC firm that we hold in high regard, it's going to be a lot easier. Even if it's just a few years, we understand, then we are comfortable that you understand how it works in a commingled structure, how it works with larger check sizes. I think that's the other thing that's always hard for us, right? Is we go, okay, they did great, but they invested a total of, $8 million. And now they're trying to raise $100 million fund. And so how do we get comfortable with those check sizes? But, we will, again, I think if you have that track record, you're already one step ahead, because not everybody has that. And I think if you can really show strong track record, it does show that you are able to identify strong companies, which that's what we want. At the end of the day, we need returns for our investors. And so I would say, keep those track records handy, and stay consistent and be disciplined in them, because they can actually go a pretty far way.
So it definitely sounds like for folks who haven't had any experience in venture so far, that working at a great fund is a great place to start, where at least you get to learn firsthand from some of those best practices. And then if you don't necessarily want to work in venture full time, starting to build your own track record is important, at least being able to demonstrate these are the investments that I've personally put money into, and this is how I've been helpful. So both are important pieces for folks who want to eventually transition into spending more time in a venture role.
Yep.
Perfect. I know we have a question in chat that I want to take first before I ask other questions. So I know Andre's question was just asking if investing in diverse manager or a thesis around ESG is a real thing. Like, is that a reality out of venture too? Are people actually invested in investing in diverse managers and in ESG related thesis?
Yeah, it definitely is. It's definitely something that's a focal point. Interesting enough is we have a lot of interest. I cover diverse managers, and I really just look at the composition of the manager, not what they're investing in. But a lot of our clients are saying, well, I also want somebody that is also focused on investing in diverse entrepreneurs or in ESG type sectors. And it doesn't have to be solely. So what we're seeing a lot of is, because there is a big push and focal point on that right now in the market and from investors, is that they track it. Like, hey, it's not like my sole focus. I'm not only going to invest in underrepresented or historically underinvested categories, but I'm going to track it. And I'm going to show you that, because especially like diverse led firms and managers, your networks just tend to be more diverse. Like, where you're sourcing from is more diverse. You're more open to things and so it's naturally trickling down. And so I think it's really great, and our investors love to see it. If you're a manager or thinking about it, think about tracking that. Like, how much diversity do we have at our board, at the board level? How many, diverse entrepreneurs did we back? 60%, 50%, we're really seeing about a 50 to 60%. And I think also when they track, the board level, because they also track how many we helped bring in board members last year, and 40 of them were women or something. Like, those stats actually really matter. And so it's not that it's the sole focus of these managers. Now, some it is, and some actually get more attention because it's harder to find those and that do it well, right? We don't want it, like, it's great to have the mandate, but then we also need to see that you're doing it well. But I think that there's something to be said for venture investors and managers that track it and are showing real progress in it. That goes a long way. So it's a focal point across every strategy that we look at. But I would say, especially in venture, there's a lot of investor demand for, are they going to change the makeup of who gets, because we're all reading the stats, right? And they're terrible. Like, 1% of venture goes to women and minorities. Like, they're not good. And so we're all reading it and saying, well, how can we do better? And so I think those are the ways that we're seeing either you're solely focused or it's at least a big topic and something you're aware of and something that you're actively like tracking and improving on.
Absolutely. And I think people are really excited to hear that because you can probably tell even by just our participants list of everyone who's on this call, we have a really, really diverse cohort. And so I do think people are really excited to see this become a real trend, not just something that companies talk about, but it really sounds like for the first time that allocators are really serious about backing venture investors who are truly diverse in all of the unique ways that they are. And I want to make sure to take Cecilia's question as well. Her question was, what kind of reporting do you typically provide to clients? And how do you communicate underperformance of funds to your clients?
So we do quarterly reporting for our clients. Every quarter, we look at every financial statement that's come through. We're also inputting every capital call and distribution that comes in. So we are real time tracking. So while we trust all of our managers wholeheartedly, we do actually independently run and calculate our own IRRs, DPIs, overall multiples. But we are inputting that, and on a quarterly basis, we show our clients every single fund in their portfolio, what strategy it is, what the net IRR, the net multiple, the net DPI, and in venture, it takes longer. It takes longer to get distributions and money back. But we keep track of that, and we show that, and then we also benchmark. So we also will benchmark every fund in the portfolio to whatever the most applicable benchmark is for them. So we'll use pre-Quin, early stage venture capital, or if it's a multi-stage venture, we'll use all VC. So we will benchmark and we'll show them by IRR where are they ranking, by TVPI, where are they ranking? And so we do that quarterly. And then we also, when there's underperformance, a lot of times it'll come up when we're reviewing. So we do quarterly reports and we present to the boards, the investment committees, and the staff. So everybody is seeing it. It's very transparent. But we're also doing ongoing monitoring all the time. And sometimes there's a story or a reason to it, right? Like, even in venture, we kind of laugh, for like, okay, they're third quartile, but they are generating you like a 29% IRR. Like they're doing good. Like that's what they were going to do. Or there's been issues, and a lot of time that's organizational issues, and that's usually something we're monitoring. Some of our clients actually have a watch list or a probationary period, and that's usually if there's significant underperformance. Like a lot of funds, when the energy market imploded a couple years ago, the portfolios, anything that was energy heavy just blew up. And so a lot of times, so we had to spend a lot of time with managers on that. When COVID hit, again, all the valuations imploded. We had to spend a lot of time with the managers, and those are calls to understand, okay, what's really at risk for being written off, what's not. And then we're always constantly communicating that to our clients. Again, typically on a quarterly basis, because we don't want to be too reactionary. Like COVID happened, and then it was the most V-shaped recovery ever in valuations. And so if we had spent all this time like stop everything, it wouldn't have, actually worked, because everything was back by the time we got the information out. So we try not to be too reactionary. And then it comes to re-ups. And when you come back around to fundraise the next time, we, as part of our full due diligence and analysis, we look at performance, and we look at the team, we look at turnover. If you had a lot of turnover, if there's been issues, those are the things we'll focus on, and they just won't come back in. Very rarely, because right in private markets or private equity or venture capital, these are 10 or 12-year terms. Like it's not like in the public side where I go, okay, well, just sell it. We usually don't sell it on the secondary market or anything. We'll just hold it through to maturity, but we won't re-up and things. And I think she just said, what system? So we use Investran. We use Investran internally, and then we have our own proprietary database called Mercer Insight, which houses all of our research. And that's where managers come on. But on the fund reporting side, Investran has been our long-term system.
I know we have a hand up. I have actually one last question for Amy, and then I would love to open to questions. So anyone else who has questions, please feel free to get that ready as well. And you're welcome to put your hand up anytime and just turn on video and mic so you can introduce yourself and ask your question. So the last question, Amy, that we had for you was, we talked about DEI, but would be really great to also look at it from kind of a higher level perspective in terms of just thinking about the changing landscape within venture, looking at the past, looking at what's currently taking place now and your expectations going into the future. Would love to hear what you identify as some of the top trends in this changing landscape.
I just think, overall 10, 15 years ago to now, the amount of dry powder that's out there, the amount of capital that's out there, the amount of, funds are growing, the number of fund sizes are growing, the number of investors who want to add venture or private equity to their portfolio, the amount of investors that want to increase exposure to those areas. I mean, I would just say exploding, to compare to where it was. And it's gotten more sophisticated. Like I said, when I first entered this industry, it was just like this catch-all. We had like side pocket hedge funds mixed in with venture, mixed in with like a real estate fund I did back in the day. Like it was just this hodgepodge. And now it's people have broken out. I have a real assets portfolio. I have a private equity portfolio. And within there, I have allocations. Usually it's a 20 to 40% allocation of venture we're seeing within like the overall portfolio. Buyout remains to be the largest. But I think that will continue, and that people really are looking for more opportunities. And what I really see is the future, and what's changing now is just that diverse manager landscape. And whether it be, now I will say investors are at very different places in their DEI journey. I did a podcast a couple of weeks ago, and I literally titled it Curiosity versus Conviction, because like there's a lot of curiosity, like what should I be doing? Does diversity matter versus this is our policy? But I think that that's going to continue to evolve, and there's going to be continuous demands on that. And so I really think that going forward, not only is it going to continue to grow at the gangbuster rate it has been, but I think that there's going to be a lot more growth in the diversity of what we're seeing out there and the opportunities out there. And hopefully the more support we can get out there. So that's where I think it's going, but I don't think it's slowing anytime soon. I think it's just going to continue. I think maybe the sectors will change, right? Like we have so many of our clients interested, but nobody's ready to do anything in like cryptocurrency. Like I want to get in, but like those types, AI, like those types of industries. So I think that we'll continue to see really large growth in those kinds of sectors, and more comfort, and potentially more investors spanning out beyond like, I want to do healthcare venture.
Very helpful. In fact, as venture is blossoming into its own category in its own right, hopefully many of our folks on call today will get to play major roles in shaping what that future looks like. But I know, Annie, you've had your hand up for a while. Would you like to ask your question first?
Thank you so much, Sho and Amy. Thank you so much for doing this. My name is Ani. I'm a product manager at SAP Labs. I work on NLB tech and stuff. My question really was kind of a segue from the reporting metrics that you said you provided. For those of us who come from an operator background, what kind of financial skills and financial literacy skills do we need to pick up to be able to convey all of these? And if we don't get an MBA or something, how do we really pick this up?
That's where I think, the working at somewhere to get those skills. I mean, you do need, a lot of it is fund account, like if you're looking at the reporting side, you're going to have a fund accountant doing that. You're going to have, eventually one day a CFO or someone doing that. I think, but I do think that it really helps, just classes. You don't need an MBA, but you definitely need to be literate in it. Working in, at an investment firm, that's one of those things that we really want you to get from that, as well as where I think the financial literacy is really important is how do we underwrite deals? What tranche are we going? Are we doing a safe note? What are we doing? And that's why we're always looking for an investments background of some sort. You've worked somewhere of which you've done that, because you will get experience most of the time to those types of things, whereas you don't always get it on the operator side. So it's hard to say, but I would say, classes plus do something in investments, get that literacy. It won't take long. Everyone's very intelligent and you can learn how to do it, but it's just being exposed to it. So in any sort of way that you can get exposure to that is real important. And we've even seen it in someone doesn't want to fully join a firm, but they will, help on different programs or different offshoots or different scout things, or you can find it without having to go join Sequoia. You can figure out different ways to do it. But I do think it's really important to have that. And that's the exact reason why we always get a little nervous when it's an operator only background.
And Amy, I'm not sure if you would agree with this, because I think this is what you were starting to get at the very end as well, is that if you're not necessarily working full time on the venture side, becoming like a scout or a venture partner or doing some work in some capacity is important. And then going to the track record point, maybe to some extent them writing checks and being comfortable in terms of putting their money where their mouth is and investing in some of those, or even investing on a fund level, what they're comfortable with, but getting exposure to that. Does that sound like kind of down the path of where you were going to get at?
Yeah. I think there are so many, especially now there's so many different opportunities, and it's really using your network and figuring out what works best for you. I would say the other thing, that's because you just mentioned, if you're not working in venture full time, something else that I would mention, if you're starting a fund, we need it to be full-time. And it's hard, right? Because it's well, that takes money, and I'm, trying to raise a fund, but I don't think we've ever gotten there on somebody that said, as soon as I get to fund 2, this is my full-time gig. So just something, we would rather you angel invest and do something, do whatever you need to do. Because once you launch, we want this to be it for you, because that's why we're giving you millions to invest. So it just made me think of that when you said that.
Super helpful and great question, Ani. Sorry for mispronouncing your name earlier. Thanks for that question. I think I saw Michael's hand up first and then David after. Michael.
Oh,
Hey.
still mute. Yeah. Hey,
Yeah.
thanks for the presentation. And so my name is Michael. I was an engineer in one of the startups in Silicon Valley, but I'm going to join a venture VC back in China, in Shanghai. And so since you mentioned how you as a consultant, how you help your clients evaluate different funds, I kind of want to know that, have you ever done any evaluation on fund managers from China, and what are some characteristics you've seen in their strengths and weaknesses? And since, basically, if I were to raise a fund
I literally just from Leap made an investment in an Asia VC a couple of weeks ago. So we have an Asia team. Most consultants do. We have boots on the ground, usually in Europe, Asia, and North America. So very interested. I think that's great. Good luck. That's great. Silicon Valley back there, you're building that track record. But it's the same. We all use it. It really goes back to those 4 points I said earlier. And it's got to be, I think, obviously China and Asia venture investing is a hot topic right now. We do have a couple investors that are pulling back just from, the political things that are happening and everybody, but we're actually positive on it. We actually think, don't stop, keep going. We actually see VC in Asia as a good thing right now. So we're a little different than some of our others in the market. But yeah, it really comes to, it doesn't matter what region you're in. You have to have the strategy, you have to have the team, you have to have a track record, and you have to have alignment with your terms. we use the same standards, the same everything when we look at anyone. It doesn't matter where you are. But I think the good thing for you to know is that any consultant is actively sourcing VC managers in that region. And if you're able to kind of put that together, it sounds like already you're starting to build your resume to that success, is that nothing changes in what we look at. It's a little different, like I said, just with the political stuff going on, but we actually see it as a good thing. So you might get more capital going into it. I don't know. But I would say really just focusing on the fundamentals of how you set it up.
Great
Awesome.
question, Michael. In fact, I feel like Michael, not to put you on the spot, but I feel like his background is such a great example of how you can ease into something. Because Michael, you spent more than 10 years working in engineering across all these big tech, and then you went into working for a unicorn in the startup side. So getting that startup exposure, and then you started doing scouting work for a ton of venture funds. So I feel like that's kind of
perfect. Yeah.
ease into the world of venture, which is great.
Yeah.
So that's perfect. Awesome. David, please.
Thank you so much. And I think Michael is incredibly well positioned to tackle the world of venture, and especially in today's changing economy. But for the next question, I'm gonna be honest, I cannot take credit for it. This comes from Victor, who's one of our fellows who couldn't make it. And his question to you, and you talked a lot about this already, but piggybacking back on the DEI, the diversity and inclusion kind of aspect of it. Two-part question. One, what prompted your own interest into the DEI space? And then two, is it too early to see alphas being generated in investing in diverse managers, or are we already seeing some alphas generated there? And I think that's largely his question.
Okay. Well, I got interested in it when I was born as a woman. So that started there. Very, hey, this is actually a lot harder. So, it was something that it wasn't really top of mind, honestly, when I started my career. It was, you just found the best managers, and you see, it was interesting. They'd be like, oh, the client will find you in the room because you'll be like one of 4 women rather than you trying to find one of 400 white males in a suit. And so, but it was never too much of a focal point because the market, there's always been diverse managers. At Mercer, we made our first diverse manager investment in 2007. Like, it's always kind of been there, but never been, does it need its own category or its own dedicated resources? Like, we always just did it as part of why cover buyout. So within buyout, we look for the best managers. And so I think for me, when I started to really see the swell of amazing managers in the market, we got there were some emerging manager programs, 8 years ago, 10 years ago, it kind of blew up and we got a little bit of a bad name. And I kept saying, it's not emerging manager though. Like, that's different. Emerging manager that's a different risk profile. That's totally different than a diverse led firm. And so to me, when I started seeing the abundance of opportunities in the market, that's when we said, we got to do something. And our clients are asking for it. Our client, we live and breathe to serve our clients. And so we started, you see the trend very quickly when they start to say, well, I want more diversity. Well, and I'm like, great. Yeah. Can't wait. I would love to give you that. So we've been waiting for this day. And so I think now spending a lot of time in the industry, just again, going back to, it's not an emerging manager program, right? We are building portfolios with fund 1s, fund 2s, fund 5s, fund 6s. And we're just really, excited about how excited everybody else is about actually adding diversity. And it feels different to us this time. There's been a couple of times where it's like, oh yeah, it's important. And then it kind of died after the board meeting and we never saw any follow-up, and we'd ask them out and they would never get to it. But there's real policies getting written now. And so I'm just really excited to be part of it, part of this inertia that's been building. And it is early, I will say, I get this question all the time, which is surprising that I still get this question, but well, what types of return, like how much lower are the returns going to be? And I'm like, zero. Like if our manager is selecting, right, like I was actually in a conversation with someone last week, and he said, is DEI investing clean tech investing 1.0, when like clean tech blew up in 06, 07. And I was like, no, that was really like a sector. And this is manager selection. This is, as long as we maintain the same standards, I don't think, every underinvested person's going to just, mess everything up. Like, it was just such an interesting thing to be asked. And so it was a great conversation, but that's where people are at. Like, and so I think we continue to fight on returns. Research is somewhat limited, but growing. And I think overall it shows that they might not be better returns, but they're not worse returns. And if you are holding, like at Mercer, we hold everyone in the same standard. It's not, oh, it's a diverse manager, let's bring down the standards or the requirements. Everybody's got to live up to it, to the 4 pillars that we really look at. And as long as we're doing our job in underwriting managers, we should see some, some great returns and some great successes. And especially we're seeing within private equity, like fund sizes are getting really large. And one of the questions is always, well, what size do returns start to fall? Because you've made it. Like, everybody that started this firm is a millionaire. And like, at what point do the founders start to drop? Well, that's when we look to replace things, because these are the hungriest people, are the ones that are starting on a fund 1, 2, 3, where this is everything they have is in that. And so to me, when I can replenish a portfolio with something that's just, 22 billion, that's just not attractive to some of our clients, well, let's take a look. And within that, there's so many diverse managers. So we really try to plug those in. But I think research is still TBD. There's research that says everything. I think it comes back to manager selection. And if we're doing our job right, and you're all setting up the firms right, I think the chance for outperformance and success is really high.
Really
so much.
appreciate sharing that. Sorry, David, please.
Oh no, I was just going to say thank you. And it's such an incredible answer that provides a lot of depth into how to how people are looking at these things from the other side of the table.
Yeah, and like I said, it is definitely a wide range. I can tell just by those questions. And then I met with somebody the next day that said, oh, we just passed a social responsible investment policy, and like, we're only doing diverse and ESG because there's so many managers out there. Like, why would we just not do that? So like, I have that. And then a person that's like, this feels like clean tech 1.0. So we see it all.
There's actually a quick follow-up question that tags along naturally to that conversation from Cecilia. She was asking, are there challenges you see in your leadership role at Mercer, particularly when it comes to looking at diverse managers? What are some of the biggest challenges you've come across?
Some of them are trying to get our understanding where our clients are. And it's, we provide opportunities, but that doesn't always mean that they're ready to take the opportunities. But then everyone says, well, how's your diverse man? That's part of the reason I want to raise LEAP is like, I was like, I want to invest, like, I want to give capital, because sometimes it's it tends to be a longer road. And there are a lot of newer managers in the diverse manager space. So I would say one of the biggest things is just underwriting emerging manager, because it does take more time, and then getting clients comfortable. I think in 5 years, the amount of more mature firms in this space is just going to be, that's why I think that the allocation to diverse managers is just naturally going to grow, because there's so many that are starting out or on their fund 2. And for us, it's kind of an emerging manager we consider up into fund 3, kind of when you reach a fund 4, because even when you're raising a fund 2, there's not usually realizations in fund one. Like we're kind of taking your word for it that it's going well and that these are the real valuations. We walk through valuation policies, but and then fund three, by the time you're raising, fund two, you just finished, there's no realizations. And like, you've probably gotten 1, 2, maybe 3 realizations. So like, but then once you reach fund four, they always say like fund three and fund four, these pivotal where we're like, okay, you better have proved out something. We kind of go on a whim with fund two, but fund three and fund fours tend to be a little harder to underwrite. So I think overall, the main difficulties are the mergent that so many new managers in the diverse manager space, getting clients where they need to be in their policies. And a lot of them are trying to also measure the diversity in their current portfolio as a starting point. So they're like, let's do this. So we have a lot of clients that we're just helping write their policy, measure their diversity, establish, one of the main questions that a lot of investors are thinking about is, should I actually like put a percentage? Should I say, I want to be 40% diverse managers by this time? Or should I just say, I want to ensure that I have better diversity within my portfolio? And we actually tend to like it to be open-ended because we feel like you set a percentage and then people will say, oh, okay, we got there. Great. We want this to be really ingrained, but I would say just trying to get them on. And then I would say the last thing is honestly, bandwidth. Like, I think every event I go to, I would say 20 to 40 new opportunities are like emailing me. And that's a lot. And we do a lot of events. So I actually just had a meeting today where I'm like, all right, I need more dedicated resources. Because while it's ingrained in what we do, like our venture, our head of venture, Eric Seabush, he spends a ton of time in the diverse manager space. Him and I take calls together, but it's still different from, I have 40 emails that I need to go through in the next 2 days because I want to be responsive. So I would say bandwidth because there's so many opportunities coming in right now.
Super helpful perspective. In fact, it actually ties in perfectly to one of the questions I got through DM that streamed in from actually a long time ago. So Anya, I'll take that question really quickly before yours. The question was along the lines of, are there too many emerging managers now? And then if so, how can they stand out? In the sense that I think whenever we see an explosion of industry, like all of a sudden all these startups are starting or all these venture funds are starting, what do we do about that? So I think that relates perfectly to what you were just starting to talk about under diverse managers too.
I mean, I can't say there's too many. I mean, I think it's great. And unfortunately, I was reading a PitchBook study a couple of weeks ago, and they did a study on emerging managers, and they found about almost 50% of fund ones never make it to a fund two. So, and then of the fund twos, about 30% of those never make it to a fund three. And so it's naturally going to happen. Unfortunately, it does happen. So I don't think you can ever say the pool is too big because I love opportunities. I love investment opportunities. I love great investment opportunities. And so I think it naturally weeds out. And I think a lot of the things we've talked about tonight are some of the things that people start and go, oh, wow, I was not prepared for that, or I just couldn't fundraise. So I think that I don't think it's too big. I think the harder question is how to stand out. And I do think that that is a really hard question. I would say more than anything, just tell a story, because everybody comes in and says, okay, this is why I need to be in venture. So there's this huge market opportunity. And you're like, that's just it. We hear it all the time. But the things that I remember is a story, and it doesn't have to be even just something that resonates where I go, oh, and what actually typically sticks with me is I always ask somebody, why'd you name your firm that? And they usually have a really interesting story. Some are more interesting than others, but that's like when you're naming your firm, have a good story to tell with it. That's something I remember. I'm like, oh, I remember this firm because, some I don't remember because it's not a very good story, but So that's one way, or just being natural. I think we get so, I did this, I know when I've never fundraised a day in my life until, last year. And I would be like reading my script and ready, like I got data points, and I would forget to just be human. Like, that's what I remember. I remember the person that we just had a really human conversation, and they talked about, this was really hard, but this is how I overcame it. Like, stories, metaphors, those are the things you remember, like, oh, that was a great metaphor, that person, or a quote. Like, those things really stand out. And I think also, just when you're presenting, like, don't bury the most important thing. Like, if you're sitting on the other side of the table, what is the most important 3 things? And like everything else, it's okay to have a page in your pitch book that has a picture on it and nothing else, or 3 words, because then you're going to take me on that story. And so to me, it's not, we see a million pitch books, we meet with a million managers, just figure out the way to be memorable, and don't take for granted, like, work with a presentation coach, work with, I've been working with someone and it's helped so much. I'm like, what do you mean tell a joke like that? And then it's so funny. Someone's like, I remember this joke you told. I was like, that felt so weird, but yeah, it was being real. So I would say, to stand out, that's more important, honestly, than like, gosh, I just have like the most beautiful PowerPoint presentation you'll ever see.
That sounds like great strategy. And Ani, I know you had one more question.
Yes, thank you so much. So I actually had a question somewhat in the DEI space as well. So there are a lot of regions in the world which maybe have a lot of talent and a lot of opportunity, but maybe don't see as much capital. So is that also kind of a focus in the DEI space? And how can we address it, and how do funds generally approach that as well? That was my question.
I've seen so there was a big push in our industry, gosh, probably like 5 to 6 years ago, where it's very emerging market focused, focusing on, India, Brazil. There's big emphasis on Brazil for a while that all ended up not going very well. So there's been a less emphasis on that. I would say I'm not seeing that included in the DEI talks. I do see, well, if I want a global portfolio, how do I define diversity outside of the United States? Like, so like in Asia, a lot of people have been going only female founders. Those are more the conversations. I honestly haven't seen a ton of emphasis placed on more, like, I want more capital in underserved areas, or, typically, which are emerging markets. That had happened, it kind of blew up. And I will say, the one place we're seeing a lot of new funds come through, I don't know if they'll like actually raise capital, but are focused on Africa. That is, I am probably seeing, I think I have like 3 managers this week that are launching new Africa focused funds. So I would say, of all areas, Africa is probably the one we're seeing, but it's not really been part of the D&I or even ESG really conversations that we have seen from clients.
Thanks.
And I saw the quick follow-up from Michael. He's asking if that also applies to LATAM overall.
Yeah.
I know we have a few fellows here who have a LATAM background as well. So if you have any follow-ups, please feel free to chime in. I had one more DM question that if there's no one else who wants to ask a live question, I'll take this DM question as the last one. Oh, David, I'll let you do the question live.
Oh, by all means, feel free to go first. Like, just
Don't worry,
itching
it's a
curiosity.
DM question. I can read it afterwards. Go for it.
Okay. You were talking a lot about the differentials between like a fund 3, fund 4, turning into like from an emerging manager to an emerged manager, so to speak. I'm curious if, for example, a GP were to start a new fund with a new thesis, but they were part of a fund 4 or fund 5, they have a track record for proving something. Do you count that GP as an emerged manager or an emerging manager? Like, which category do you put that under?
Would they be like, I invested at this place till fund 4 and then spun out, or I'm still at the firm but I'm
still at the firm.
a new fund.
So like, for example, like a GP has been focused on consumer the whole way. And then after like a fund 5, after their learnings, they're like, I kind of want to invest in crypto because it seems to make a lot of sense, but they have a track record for like investing consumer. Do you bucket that new fund or that manager in the emerging bucket or like the emerged bucket?
It's a great question. We typically do not see them as an emerging. They are, once you bet, because for us, when we look at emerging manager risks, right, a lot of it is around the governance, the team. That's kind of de-risked it up. Like if you're on a fund 5, you're just kind of launching something new. You're lower risk to us because obviously the team has been together. You have a track record of managing a fund, investing a fund. So we wouldn't put you back in that bucket. That's really saved for, because we look at it from a risk profile, and that's really what that is. And we're seeing it a ton in venture. I feel like every venture firm, early stage venture, is now launching a growth opportunities fund. It's the biggest trend. We're underwriting them together, but just because they're doing a growth fund 1, you're still an established manager because you have 7 early stage funds under your belt. So we really look at it from the real fund, not the offshoot fund series.
Thank you so much.
Yeah.
So this DM question that came in has kind of 2-3 parts. So one part of it is for folks who want to start building up track record before they become a diverse or emerging manager in this category. What would be your top recommendations for how to demonstrate that track record? Is it better if they do direct angel investments, which for them is much higher risk? Or is it better if they were to, say, invest in another fund where they can be a scout and do some work with them? Or is it better to do something else that we haven't even talked about so far?
Any of those, just
whatever they're comfortable with. Okay.
Honestly, I'm not like, ooh, if you're an angel, that's better. That we just need to something. So whatever that looks like for you, wherever, because that fits differently. It's when you say, I've never invested, but I started a company and I sold it and now I have all this money and now I think I can do this. That's when we get nervous. However you want to show us that you can choose good companies and also get access, right? Because there's a lot of, we know these companies. We have an entire venture team that spends hours, 18 hours a day looking in the space. They're going to look at it and they go, oh, wow, they got into that.
Mm-hmm.
Pretty good. So we're not only looking at your track record for, the outperformance, but we're also looking at it for what have you sourced, what have you gotten access to, because that's where your networks come in, which are so important.
Super helpful. The second part of this person's question is really just in terms of thinking through what timeline. So if they're currently working full-time in a different role, whether as a founder or working in big tech, how long would you recommend that they do scouting work for, or doing sourcing work for, or be invested in other categories before you would recommend that they start full-time?
We see all sorts of tenures. We see 2 to 3 years, 2-3 years usually minimum. A year kind of causes us some like, why they only last a year. I would say 5 years is optimal, because that really shows us, you were somewhere, you were there long enough to like get up to speed, hopefully start leading stuff. A lot of times when people join, it's like, well, I was under this person, I was supporting, then I moved in this role. So I don't think that there's a totally right answer. We've backed people that left somewhere after 2 years. 10 years is fantastic. 5 to 10 would be our optimal if we could get you to stay there that long, but it's also not, I would not say it's a deal breaker if it's, at least 2 years or more.
Mm-hmm. And then the last part of this person's question was just in terms of action steps within that timeline. If there's specifics of how much time you would recommend them spend on developing each of the skill sets that's core to being a good investor / fund manager. If you would recommend that they spend regular time on sourcing every week or on writing more investment memos or testing different investment thesis, if there's particular areas of very specific action steps you would recommend that they prioritize.
It's so hard because you never know how your fund or firm's going to come together, right? Like you could have spent no time on the operating side, but you recognize that and you partner with somebody that's a great operator or vice versa. So sometimes I feel like people get like, don't get too caught up, like know what you know what you don't know, find some compliments, look at the whole team and what you're trying to put together. It's hard to, it's such a wide range of things that we see that I don't think that there's one good answer. I would just say, if you are ready to go on your own, again, partner with what you don't. And we love that, actually. Honestly, we're like, sometimes it's hard to be like, you're the perfect operator and the perfect investor. Like sometimes I'm like, you can't even be perfect at both. So we like the complementary experience that comes in. And so, yeah, unfortunately, I really can't think of the specifics, but I would say just overall, build a track record, hit on those 4 things we talked about, and make sure that you put together something that's really interesting for people to listen to. You'd be amazed. Sometimes we get clients that bring us something and I'm like, where did you find this? And they're like, I met this person. I just was like, so interested in I'm like, I would have no, like, I can't even get to a positive recommend. Like this thing is so, and they'll do it anyways. Like sometimes we don't even get to a positive recommendation and clients say, doesn't matter. We love it for a strategic fit. A lot of our healthcare clients, or, we want to do it for whatever reason. So you'd be amazed at how far, like some people use your networks. Like if you have people that are investors places, because we've seen all sorts of things get through.
I actually feel like you had the perfect recommendation, which is figure out who you want to work with, right? That's the specific action step of
Totally.
Whether they're your partner at the fund or there's someone that you work with regularly on looking at deals together, having that kind of relationship and really developing that depth of relationship over time. So I think that's a super great practical recommendation to end on. And I'm sure that can help everyone in this fellowship get to know each other better and explore working with each other better over time as well. I know we had some other quick questions, but I know we're at time. So Amy, I'll just throw those questions really quickly out at you, and you're welcome to answer it either very quickly or we can do follow-ups on email afterwards. So Cecilia's question was what your general approach is when you recommend clients between a very big name GP versus a smaller or emerging GP. And then Michael's question was related to kind of the pivotal moment for Fund 3 versus 4-ish. What's a definition of realizations that clients or investors or consultants actually expect? Does it have to be specific successful exits, or is it just hitting certain valuations for portfolio companies?
General approach is, your client. Some love big names. I would say more are starting, again, because the fund sizes are multi-billion dollars now, and they're like, show me something new in the market, but it's really client specific. So I know my clients. I know somebody that's like, nope, we'll never do a fund 1. Don't show it to me. Great, watch them, bring it to me in a fund 3. I know other ones. I just, wrote out the 2022 plan for one of my clients, and 2 of the 4 are fund 1s. They love it. That's where they feel like they get that additional return generation. Great, KKR is going to get me 15% every day, but I would also like to have a couple of outperformers. So it's very client specific. And we recommend them the same exact way. We underwrite them the same exact way. You know who's comfortable with it and who's not. And then to Michael's point, I would say realizations to us are actual, you've sent a distribution. So we have received capital, doesn't have to be a full, doesn't mean we have, the company IPO'd and we sold every share of it. It doesn't mean we sold the entire thing to a strategic. We look at realizations as real capital that we got back. Because we look at unrealized value too. So we look at both. We we look at the portfolio and we say, okay, it's generating great returns. How much is unrealized and how much is actually we've gotten money back? Because for those funds where we've got money back, it holds a little more clout sometimes, but we also get the reasons for holding shares and not selling them. But when we think of realizations and what we're really looking for in there, it can't just be all unrealized. It can't be everything's great and we've written it up to what we think the market is, but we've never sent you $1 back. Really sorry about that. Like by the time we get to fund 3 or 4, because when we do it, we also benchmark the DPI, which is distributions to paid in capital. That is a straight, how much have you sent us and how much have we given you? And that's benchmarked. And so not only are we benchmarking returns, we're also benchmarking the rate at which we're getting distributions back. So it is a metric that we measure in diligence.
Awesome. With that, thank you so much for sharing your time with us today, Amy. Really appreciate it. And hopefully, as all of our fellows here become awesome and amazing investors of the future, they'll also remember to reach out to you.
Yeah, keep my email address. Yeah.
Sounds great. Thank you so much. And for everyone who's on call, if you can unmute and let's give Amy a very warm round of applause. Thank you.
Thank you all for having me. It's been great.
Thank you so much. Have a great rest of your evening and take care, everyone.
Thanks, everyone.
Thanks.
Thank you. Thanks.